Hello and welcome to this talk about investment trends and opportunities with two of Asia's leading venture capitalists. My name is James DiBiasio and I am founder of DigFin, media, business, and content agency covering digital finance, fintech, and digital assets, as well as author of Cowries to Crypto and just out Block Kong, profiling entrepreneurs in Hong Kong's blockchain community. With me today to discuss for you, the community that is probably interested in engaging with venture capitalists, I've got two very experienced people here. I've got Se-Min An, who is managing partner at Rakuten Ventures in Singapore. So welcome, Se-Min.
It's very nice to be here.
And from Hong Kong, where I'm also located, we've got Mark Munoz, who is managing partner at Vector Ventures. Excuse me, Mark.
Hi, good to be here.
All right, great to have both of you. And so we're going to have a really interesting discussion that will hopefully get into some of the nitty-gritty that if you're a startup and you are either looking for capital or you're dealing with your venture capitalists, or you're someone who's perhaps helping that process along, we want to provide some very real-world information and tips for you. So it's May 2021. We are well more than 1 year into COVID, and for the past year plus, the message, when I speak with companies left, right, and center, is all about how COVID has supercharged digital onboarding, digital acceptance by consumers, the need for companies to digitize this, that, and the other. So I think we're now done with this. The trend isn't over, but I think the idea that you're going to differentiate yourself by being a digital solution is probably no longer that much of a differentiator. Maybe I'm wrong. Se-Min, maybe you'd like to give us a sense of, what is the differentiator of just being a digital play in 2021? Does it still matter?
I think it definitely matters. One thing that I've seen, because Rakuten Venture invests globally, is I want to say kind of essentially three buckets of geographical specificities that have happened. One is obviously people and countries that have actually gone out of COVID and have made their economy and their consumption much more robust. And in many ways, things have actually come back to normal. Look at Taiwan is a very good example of this. If you look at countries who are still going through a lot of the rigmaroles of COVID infections and also mortality rates, such as places like India or even the US, I think there's a different way of actually people thinking about consumption and whatnot. And then there's, I think, another bucket where things are still very, very, dire, but in many ways, the economy still pushed itself along, and the consumption, as we thought about in the perspectives of during the COVID era, it is still really, really occurring. In the first bucket, where you see a lot of recovery because of good governance and being able to actually tamp down infection, I do see economies actually reinvigorating to the offline era. So if you were highly online focused, there's actually a convex kind of mentality where people, because they're actually consuming offline more and through more of the traditional mediums, it's not that big of an advantage anymore. There is some habitual, residual kind of consumption habits left, but a lot of people revert back to their normal consumption habits. The second bucket, where people are still going through a lot of the issues and whatnot, indeed, have really looked at online as still the bigger kind of differentiators. But to your question, in many ways, yes, you became online and you had an advantage, but at the same time, the bigger players have actually bifurcated the market and taken a larger share of the wallet. I think on the third bucket of things, if you look at kind of the overall economy, where economies are still very, very bad and whatnot, you see a lot of utility consumption plays such as food delivery and groceries become much more of a specific consuming habit. And indeed, as your question goes back to what's your differentiator, I think the vertical focus has become a very, very big kind of placeholder for how robust your business grows, and kind of carving out the idea of sustainability for you.
Right. So if I can interpret that, Se-Min, what you're saying is that having a niche and adding value within a vertical
Mhm.
healthcare delivery of some sort
Yeah.
is more important than the degree to which you are helping somebody digitize a process or you're adding some sort of tech solution to that vertical.
Definitely. And that supplementation, that onboarding process has been really done, and the Shopify's of the world have gained immensely from that whole process and that whole economy. But at the same time, as you say, Jamie, as we get out of that curve, you will see that now, how do you actually make that consumption, that action of acquisition more habitual, is still a question that, especially for SMEs, are still unsolved.
Yeah. Okay, great. So Mark, what's your take on this? I mean, again, a year ago, I'm sure we probably had a conversation in which you talked about how digitization is changing the game for a lot of people, and you've probably got some portfolio companies that are driving that trend. How do you see it's played out? What's relevant now?
For us, because we invest at the seed and Series A stage, we are sort of the first institutional checks into some of these companies that are trying to redigitize the world and sort of this next phase of what digitalization looks like. But I think for what you asked, Jimmy, it's more important about what we learned and where we look at for investments, as well as what we tell our portfolio companies. So for us, what we saw, not too far off what Simon was saying, is that particularly in Asia, we found that there's still a long way to go in that digital journey. We found that the infrastructure that's needed, particularly in Southeast Asia, is severely lacking, much more than we realized. And so that's one. The second thing that we learned was the use of data. As much as we talk about it and our portfolio companies try to access it and corporates try to use it, it's still pretty nascent, actually. And the data that we get, sort of that hard science component of what's really coming out of these type of companies that are doing digital today, is still very, very early. So I think we've got a long way to go on that side. But go ahead.
Yeah, are all of those things that you pointed out, are they something that the companies that you invest in, and perhaps those companies and their clients, can solve by themselves? Or do you need to tackle this from a broader marketplace perspective, where you need a lot of change for your portfolio companies to be able to really exploit whatever it is they're trying to achieve?
Yeah, so actually both of those things quite interesting. So from our portfolio companies, what we were telling them was, how do you show your clients ROI? Right? Use the data to show value and sort of reformalize how you're attacking the market, how you're selling your products, what your revenue path is. Again, because these are very early stage companies. And so, going through that exercise with all of our portfolio companies was quite important, because as we were learning, watching the macroeconomic view and sort of what was happening around the world, we were also seeing, on the ground, what was happening with our portfolio companies and advising them in that direction. But I want to go back to your last point, but also to what something was said earlier, and that we've seen that share of wallet by larger tech companies just grow phenomenally. And this, in effect, is a bit of a problem, because what's happening now, and I think it's a large part of what we saw coming out of COVID, is regulatory change. I mean, just look what happened with the Alibaba IPO, and what's happening with Apple and Google and all of these other companies around the world. The governments and the regulators are taking a different approach in terms of how those companies can operate. Now, we think that's actually a great opportunity for not just our portfolio companies, but for the greater startup ecosystem around. Because as those regulations change, it creates more and more opportunity, and more dollars can flow into those types of companies. So I think it's sort of both ends, what we've learned and how we adjusted, and then again, what we think is coming around the corner with the regulators.
Right. And that opportunity, just to clarify, is because the big ones, the giant tech companies, are going to be more constrained, or they're going to face new costs. Therefore, it creates openings for small, nimble companies that can do things more quickly and cheaply.
Exactly. I mean, when you have these large corporations that are consuming so much of a wallet and have so much data, there is a natural tendency, particularly for the regulators, to sort of take a step back and say, is this the right environment for these companies to operate? And should we take a sort of broader look at it? On one hand, we want to empower them, and we specifically for what we do on our fintech fund is we do meet with regulators around the world and to try to have a better view and a better lens as to where their head is at and what they're thinking. And this is definitely something that we've come away from the sort of the COVID experience, saying regulators are taking a much harder look at not just big tech companies, but even medium-sized tech companies and what they're doing.
Right. Saman, you're in the corporate venture world with Rakuten. Going back to this point about it may be a little harder than we thought for small companies to be able to leverage the data. Maybe it's not as easy in Southeast Asia as was initially assumed. So from that perspective, are you looking for companies that would sort of plug into the Rakuten group and its kind of its ecosystem, or are you looking, therefore filling that space because you're co-developing a lot of capabilities together, or are you looking for individual stories just because you're looking for good companies with a good story?
Yeah, I mean, that's a really good question. Like Rakuten Venture, when we were founded, when Rakuten Venture was founded, what we made sure we do is we actually are the only financially focused investment vehicle in Rakuten. We are hired and fired based on the amount of net income gain we bring to the company. So in that perspective, we just simply focus on the best companies we can invest in, and we do our best to add value, whether it's products or the synergies that we traditionally talk about with CVCs. But at the same time, taking a little bit of a cynical view, we've been a lot more pragmatic about how we look at trying to help out companies, because when corporations try to help out companies, it's try to kill companies at the same time. Sorry, I'm using too many asterisks here, but I mean, it's one of these things where, we've just been a lot more sensible in how we work with the corporations. The good thing about Rakuten itself is we have about 60 to 70 subsidiaries. And for me to draw synergistic lines to Rakuten is not very hard. But going back to the original point is, it's much more easier to invest in a good company and to be able to manifest, economic value growth and then show Rakuten that later on you guys can work together when there are good lines of partnerships.
Yeah, but can I just go back to the question I sort of put to Mark, which is it possible for these smaller companies to succeed on their own because they've got the right entrepreneur, the right idea, the right business model, or are you finding it, if it's an artificial intelligence type play or it's some sort of data hungry play, is there enough going on around them to feed their story, or do you find that you need to kind of build the marketplace with multiple investments as you go?
Sure. No, that's a really good point. I mean, at least in terms of what Rakuten Venture tried to do over the past 8 years is when we invest, we try to look at ourselves as trying to build a company with the portfolio companies. So number one, we right away buffer a lot of these investment and synergistic needs with intra-portfolio work that happens very, very naturally together. But to your question about, is it enough for a hardcore AI company to be self-sustainable in the 2021, 2020 landscape of things? It is very difficult. And you see that once a trend of data, big data and AI has passed, then you try to figure out how to actually make a business out of this. And you've seen literally the whole lineup of tombstones in the US of these AI companies that first came out with guns blazing. And to that perspective, in 2021, entrepreneurs who want to build their specific niche, they need to be much more prepared than ever before. 4 years ago, try to developing a computer vision company. All you had to have was really good tech, and you had to have the ability to compress your cogs when you did compute on AWS or any cloud storage platform. Now, when you come out to try to build some sort of commerce-based computer vision company, 100% you are expected to build a business model that scales quickly and that manifests progress quickly. And this is kind of the learnings where over the past 7-8 years, especially in Asia Major, people have become hyper-maturized. They've matured very quickly in terms of how they look at an investment topic and an asset value topic. And I guess in that perspective, the aforementioned expectations keeps on rising with the amount of liquidity that is being pushed into the region.
Is that maturation acceleration due to the fact that it's so cheap and easy now for startups to build a tech stack based on cloud or something along those lines? and therefore
Yeah.
from day one you really insist on a certain capability, and therefore their edge has to come from something else.
Oh, I mean, yeah, you're like 150% right. One thing that I would add is in the past 5 to 6 years, not only just the basic access to infrastructure has been democratized, but the amount of open source products that are out there really, really commoditized many of the value propositions that maybe a decade ago might have made you very, very special. You want to come out and say, "Oh, we're a big data company," and I ask you, like, which open source DB company are you using to actually build your business? And when you actually look under the cover, you're no more than a consulting company, IT consulting company. That's great, but again, that's a very different value proposition from calling yourself a startup that's tech and IT based.
Yeah. Mark, where do you see the value proposition now? I mean, if we accept this argument that a lot of what looked kind of whiz bang a few years ago is now commoditized, when you're looking at portfolio companies or their marketplaces, what has to happen for you to be interested?
Yeah, I'd love to answer that question, but I think it's important what something Simon said earlier, which was how Rakuten operates as an entity, as a VC, because they have a return focus that then leads to strategic. And I think that's fantastic. There is a bit of, I guess, within our small industry of venture capital, sort of a reluctance to work with CVCs. But in our case, and particularly in Vector's case, we've actually had a lot of success because the transition of capital that's happened at the corporate level from purely strategic to now sort of gains based first and strategic secondary. It's kind of nice to have. It's a fantastic thing for startups in the greater ecosystem.
It expands your exit opportunities, obviously.
Absolutely, it does.
We'll get to exits later. So let's talk about right now.
So in that particular world, look, there is the ability to use great tech. And we think tech gives a lot of startups a nice competitive moat, but we also know that tech is probably in many degrees a low bar for others to replicate. It's not a very difficult thing to see something that's super cool and perhaps deep tech driven, whether it's AI or blockchain or what we're doing now in quantum, and try to figure that out. So what we end up looking for and focusing on are really two things. One is, what is that revenue model? Is it something that's really going to take off? And so, if you think about the world of revenue models, particularly in the software world, we had enterprise licenses and big installation fees, and we sort of migrated to SaaS. And so now what a lot of deals that we're looking at have consumption-based models. So it's driven simply behind the resources that you use. So that's something that's very, very keen for us to take a deep dive into and figure out how it all comes together. The second thing I'll mention is distribution. It's not hard to go out and get your first 25,000 clients, depending on the type of business you are, right? But it's much harder to get that jump from 25,000 to 50 or 50 to 150,000. So that distribution strategy and the market that you play in is particularly important. And we're also looking for companies that are solving problems, right? We all talk about that. We want to see companies solving problems, but we want to make sure that they're finding really strong product market fit and how they're going about measuring it. So I talked earlier a little bit about seeing some ROI, but it's the same for the companies. We want to see how the company are measuring their internal results. What are they trying to achieve? What do they think is success? And then we sort of look at that and say, okay, is this something that we can invest in given all of these various other factors we have to dive into?
That ROI net revenue focus, is that because you're primarily looking at B2B kind of companies? Because if we were talking about consumer-facing companies, then I would be a little surprised if you weren't talking about user numbers and growth, right?
Well, it is, but it's actually not that far different. So you're absolutely right. We tend to gravitate more at Vector towards B2B. It just tends to be our bit of a sweet spot for us. But it doesn't mean we don't do B2C, but we still hold them to the same standards. So for example, we just invested in a company out of Seattle, a prop tech company called Plunk, and it's B2C. And the metrics that we're following, sort of the return, sort of the quality of their customer engagement is measured, their NPS score is measured, their ability to attract repeat customers is measured. So all of these things still play into that quantitative ROI that we're looking for.
Is that new? I mean, 2 years ago, let's say before the WeWork IPO story, maybe we would have had a different conversation in that regard. Do you think there's been a shift?
I think there's been a shift in two ways. One, I think a lot of folks, particularly us, we're interested on revenue growth. We like to see how close you're getting to positive EBITDA first, versus the fact that you got 1 million users. Okay, well, if you got 1 million users and you're not really generating significant revenue, then it doesn't really translate for us. So that build it and they will come sort of mentality has definitely changed. I think the second thing that sort of pops out to us, particularly recently, is the ability to dive into things that are just too nascent. And perhaps this is just how we position ourselves and what we do. But doing tokens for something, for example, for us, it's just not the right fit. Which means that they're not to say that they're not great companies. There are. But it just doesn't really fit our fund. So there are definitely areas where we kind of we'll take a wait and see approach to watch the market develop before we want to dive in.
Yeah. Same in on this point around revenue. How important is revenue versus other metrics such as growth for the companies that you're analyzing?
Sure.
And has that trend changed?
I think this is going back to expectations. If you were to ask me 5 to 6 years ago, what are my expectations on revenue? I would 100% would have been more biased on what kind of product or technology they were building out. But now, if you're building out a technology plus the product, I would definitely look at the velocity of the revenue, not just the revenue per se, because you want to see how far you're displacing your before goals or your before numbers. And at the same time, I guess if you look at SaaS itself, you want to always look at something like a quick ratio or the magic numbers, where you're trying to understand where your expansionary MRRs are and what your retention ratios are. But in general, yes, definitely revenue and generally top line as a good figure of progress has been an important barometer for a lot of the alternative investors, such as venture capitalists, to look at, and even of course public equity.
Yeah, and what is I guess the way that you're thinking about the hit rate in the portfolio? So traditionally, a VC firm might only get 1 or 2 out of 10 that really do well, a couple that kind of float along, and then a bunch of losers.
Sure.
And that was okay. That was the way it's supposed to be, because these are risks that you're taking, and you get so well compensated for the winners because they could scale up crazy, and everybody's happy. Is that still the case? Is that still how the model works?
If you look at the heuristics and historical kind of projection in the past 10, 12 years, just because of how perverse and atypical the public equity market has been, LPs have been much more forgiving for the venture capital asset class specifically, just because if you just simply get to the public equity markets and you have a good fit, good noise, good marketing for the actual product and platform, there is a good chance you'll provide them outsized returns compared to the amount you've actually invested in. But definitely, you could see a lot of venture capital firms, especially the smaller ones, the spin outs. Essentially, this person was a senior partner in XYZ bulge bracket VC firm, comes out. These VC firms have provided amazing hit ratios and very, very little quote unquote attrition. And in many ways, the Rakuten Venture, because we're a corporate VC, we've just been blessed with the fact that for us, patience is not expensive, which is a commodity that is most expensive for commercial VCs when they look at deployment and actual return farming. So that, for that perspective, I think CVCs will normally have a lower failure ratio, but again, we'll have a capped ceiling for returns, while as the traditional commercial VCs have always been trying to look at maximizing their returns per the actual statistics.
Right. Okay. And Mark, any comment on this? The nature of the return characteristics. Any changes?
Not necessarily on the return profile. The return profile still sort of exists in the VC world that it has before. Depending on your multiple that you're trying to achieve, you construct a portfolio with a number of companies to try to get there, and then statistically, again, depending on your fund size, you can try to reach that level. But what we found is that there's more dollars that are going into the seed stage companies at a smaller amount. So that means that there's a lot of companies that get funded very, very early. And then on the other hand, you have the fact that companies spend a long time developing. They don't necessarily have to go public because there's a significant amount of cash at the later stage. So what that means for returns for us, it does mean that yes, we do have patient capital. We don't necessarily need to deploy because we can watch our portfolio develop over time and then invest either in smaller checks or larger checks at different stages that we need to in order to get the type of return that we're looking for. So optionality is better for us. And sure, you still have those companies that are underperforming, but they tend to stick around longer and find more and more opportunities to survive and grow.
When we're looking at Asia, I know you mentioned, Mark, that you've got a company in Seattle you referenced, but let's talk about Asia since we're here and companies that are operating primarily in Asia Pacific. Do you have the same opportunities to do additional rounds, have that optionality? Because most of the VC world here is seed A, maybe a little bit of B. It's quite rare to find companies here that are doing beyond that. Maybe that's changing, but just get a sense of how do you play that that rounding and valuation game in a market that tends to be fragmented and doesn't have the same perhaps breadth as like the US or Europe.
Sure. Well, I mean, this does drive a little bit into our fund strategy, in that I think it's challenging to be an Asia-only fund or a Southeast Asia-only focused fund. I think there's good opportunities there, but they're far and few between. Because we're specific into fintech, we do need to diversify, which is why we do have North America investments as well as Asia investments. Matter of fact, half of our portfolio is here in Asia. But to your point, James, the amount of dollars that are going into the seed and Series A companies and their ability to find the later stage and growth capital does present some significant challenges for Asia. I would say that there is a overabundance amount of capital at the seed stage. You have angels and you have accelerators and just a good group of fantastic VCs out there that will love to invest at the seed stage. The A stage gets a little bit harder. Particularly if you're trying to get to a pre-A or to an A stage. I think that we have found over the last 2 years that there's fewer and fewer of us that will do a proper Series A. And as you said, we find actually now we're starting to see a bigger trend that there is more capital at the B, C, and growth stages. Companies want to invest at these later stage, later stage growth companies in order to get them to a SPAC or whatever they may be trying to do sooner.
Yeah, as I wanted to, before I go back to Min, because I have a question for him, just on that SPAC point, is that a viable opportunity? I mean, obviously Grab is a big headline, and obviously we wish them luck because I'm sure it would have a positive impact on many other people in the region. But we see overall in the US, SPACs mostly are trading underwater. And also you got to be pretty big to justify a SPAC merger. So is that a viable route, do you think, Mark, or will we see a few more of those this year from the region?
Well, we're going to see a few more from the region, which is okay. I think it's a bit overinflated, to be honest, and I'll be the first to say it. There's a lot of just junk out there in the SPAC market right now. We are seeing redemptions sort of hit all-time records of the last 2 weeks before we saw just people piling into SPAC. So I think there is a bit of a reversal trend, but we do want to see these take place because they are great opportunities for the right companies. There are absolutely good companies that should be able to have a SPAC opportunity and find some liquidity, perhaps not just for investors like us, but for the company, and find that next stage for them. But we are seeing the de-SPACification starting to emerge.
De-SPACification.
Yeah. Yes.
Min, I wanted to go back to this question around funding rounds. Because you've got that strategic element, perhaps this is less urgent for you because you've got sort of, instead of doing a B round, you might have a strategic exit. Is that how you approach it? Is that do you find that companies might be able to benefit because of that relationship?
I think founders benefit from Rakuten Ventures kind of flexibility, and I guess that is one of the benefits. But going back to what Mark mentioned, for us, I completely agree with what Mark said, and our tact has been if you want to actually develop a reasonable and return-focused thesis in Asia, your thesis and it ends up having to be much more broader than the traditional VC firms in the US, just because the deal pipelines per vertical is much more thinner. And in that perspective, you could see specific, really big explosions of great companies happening at the later stage in places like Korea, places like Japan. Whereas, as you see in Southeast Asia, things are just happening. For me, I've been lucky enough to invest in Gojek and Carousel at similar earlier stages, and because of that, I get a lot of exposure to talking to SPACs, to talking to investment banks, and in many ways, I do think this is a normal course of how the capital markets, especially in the U.S. and other more, trade volume heavy exchanges, are going to further evolve themselves. But going back to the discussion point about how do you actually develop a reasonable business for venture capital in Asia, I think it really has to go down to being opportunistic, not only in the asset class of venture capital, but the actual venture capital firm would and should in many ways seriously consider other asset classes, touching public equity, touching credit, touching even some of the levers behind the SPAC and whatnot.
Right. And that's partly a function of the fact that our capital markets in Asia tend to be fairly underdeveloped in relation to some others.
I want to say underdeveloped in terms of the intraconnection. So in the U.S., it's just one country and whatnot. But when you have to look at and parlay growth narratives and functionalities in Indonesia, you look at, great, I'll go on IDX, but of course, because of my growth story and narrative story is much more focused in this region, I still have to find out how to get to a London Stock Exchange or a New York Stock Exchange. Right. So this has always been kind of the case where I do believe this is just part of the natural kind of evolution of exchanges and trading markets.
What's happening with, Mark had referenced a lot of money at the seed stage now in the region. Is that having an impact on, I guess, the balance of power, if you want to call it that, between the investor and the founder in terms of control, VC protections to make sure that you're, the kind of typical protections that you would bake into an agreement around the nature of the stock or the converts that you're using? Are we seeing any kind of changes? Do founders at that seed stage have more power to kind of determine their level of control?
I mean, for me, I haven't seen atypical clauses like Rakuten Venture does not. I mean, we view over-engineered protection for investors, just like there's an episode of Simpsons where Homer is rolling down the hill and he gets out of the car and he's like, I'm safe, but he gets back in the car. And basically, that's a downside protection that's not a downside protection. So in many ways for us, our downside protection has been trying to find the founders that are the best fit for us. And once that happens, many of these protective or these levers that we would normally utilize, whether it's a ratchet or whether it's a more than 1x liquidation preference, those things become immaterial for our discussion points. So definitely, we have seen some investors take that route, but we just haven't seen a lot of utility long-term in building the value economically and also the value between the investor and the founder themselves.
Okay. Mark, any thoughts on this question?
No, we just try to keep it simple. I would agree with Simon. I mean, we don't see a lot of overly protective clauses at the seed stage. At the Series A stage, it's all pretty standard. I think the idea, particularly at these two stages, is to just make it as simple and as inexpensive as possible for the company if you feel like it's the right investment for you.
Because there's so much capital going into these early stage and maybe a little bit of Series A, to what how much of these negotiations is the founder pitching themselves to you, and how much of is it you pitching yourself to the founder? Like, what's the value add that you bring to the table besides just the
That's a really interesting question because it varies, particularly between Asia and what we do in the US. In Asia, what we found is that it's not necessarily challenging for us to get into the opportunities that we want to. Definitely, as we're looking around the region for very specific things within the fintech world, we can generally find some good folks. But bear in mind that our process is not we meet with you once or twice and then we bring it to our investment committee. We generally get to know founders over about 3 months, possibly 4, sometimes even longer. And what we're looking for is we're watching them solve problems. We're tracking them in terms of what challenges they face and how do they solve it, and also how are they communicating back to us. What did they tell us? What do we know? And who else can we speak to sort of validate what's been going on within that company? So that process allows us to build a really strong foundation with the founders. It really gives us that insight, so that when it comes to, for example, doing a Series A, and there's a board seat up to grabs, we may not necessarily take it if it's available, because we have such a strong foundation with the founders that they're going to call us before the board meeting, and that's kind of our preference. So getting into the deals in Asia in particular hasn't necessarily been a problem. Now, to put myself, because I have been a founder and I have raised money from VCs, both in the Valley and out in Asia, so I know what it's like. What we also try to do is to put ourselves in their shoes and say, okay, how can we help this founder? How can we help this company? What is our value add? And so for us, it comes down to really 3 things. The fact that we have been founders ourselves. I mean, we are the only fintech fund that I'm aware of in Asia right now that has actually been there and done that, have been through, looking at a balance sheet with 60 days left of cash and going, what am I going to do? And how am I going to communicate what's happening to my investors? So that's really strong. The second is what I mentioned earlier, and the fact that we have worked with 45 regulatory agencies around the world. We've helped shape fintech policy in pretty much every region you can imagine. And so that experience gives us a unique lens, and we also can bring that to bear for our founders. And then the third is, generally our network. So thankfully, we have co-invested with a lot of corporates, whether it's big investment banks, insurance companies. It really ranges the gamut. And so to bring our seed or Series A companies to the B round, or to a C round, as we're doing now with one of our portfolio companies, and opening up those doors to these corporates makes a big difference.
We've only got a few minutes left in our discussion, wow. So I know it's gone fast.
It's gone fast.
I guess I think we should spend a little bit of time at looking at what you like right now, more specifically. So Mark, I've got you. You're a fintech specialist. In the fintech world, what is working, what's pushing your buttons right now, and what are you staying away from?
So we are, this is a funny question because there's a variety of things, but right now we're liking a lot of revenue-based financing. So there was a trend a year ago, maybe even 2 years ago, where there was a lot of invoice factoring and financing, and we tended to stay out of that. But we have now seen a number of companies that have some really fantastic business models about revenue-based financing. So we like that. The other thing we're taking a look into is in deep tech, specifically quantum computing. So we've been spending a lot of time in the region, both in Asia and in the US, looking at a number of companies in that space, because we feel like quantum computers are where sort of the first chipsets were coming out, back in the late 1950s, early 1960s. So there's a lot of room for growth, and the amount of investments going into that space is pretty exciting. And then the third thing I'll just mention, which makes a lot of headlines right now, but it's NFTs. We've seen a number of interesting business models and founders who are using NFTs in a pretty unique way that help sort of move that world of DeFi into something that people can really hold on to as an asset, and not feel like it's left to volatile public markets.
Yeah, and what would you not touch with a 10-foot barge pole right now?
Oh, really? You got to put me on a spot like that. For us, we are, as I mentioned earlier, we're not the biggest into sort of B2C. So we are staying away from a lot of trading applications, traditional brokerage firms, or folks who are coming up with algorithms to trade the markets. It's just not something that excites us.
Okay, great, thanks. And Min, from your perch, what's looking, you cover everything from e-commerce to finance to lifestyle stuff. What's what's exciting for you right now?
So for me, just similar to Mark, but a little bit different in that we're looking at photonic computing specifically on the perspectives of being able to actually lower the cost, literally the electricity cost of actually training models. There's actually an interesting a case study where they find that training AI ML models has one of the worst carbon footprints in the world. And that's because it just takes so much energy to actually develop and output that sort of production.
We're not talking
And one
about
thing that
blockchain stuff here. We're just talking about
just
algorithms on a bank's trading floor. Mhm.
exactly. So if you want to train, a BERT, the NLP model, that's 40 million clusters of transformers that you're actually working with, and apparently to actually train it to a specific outset or a specific utility case, it has a very, very bad carbon footprint, and so does a lot of the other models. There's actually a bifurcation of have and have-nots of computing power these days, specifically because of those issues. But one thing that really solves that is if you're able to actually utilize photonic computing to compress the cost immensely for the compute and model training, that could be very interesting.
What do you call that?
Secondarily,
Sorry. I just didn't catch the term.
oh, this is a photonic computing. And secondarily, there's a lot of things going around with all these hubbub around AI ML. One thing that I've noticed is everybody thinks that everybody's a good actor, but when you have money to be made, AI and ML could equally have your fair share of gray and bad actors. So I'm looking at companies that will try to prevent and develop security companies that prevent AI and ML either from being distorted or utilizing that for bad purposes. Kind of like what does a McAfee for AI and ML look like for the next generation of things? Third, I'm looking at a lot of biotech investments. We have already done $100 million investments into photoimmune therapy for head and neck cancer, but we're looking at actually CRISPR a lot these days, specifically because it's controversial. Not controversial like NFTs, but definitely controversial. And we like the development and the actual cycles that the actual vertical is going through. So I guess those would be kind of more farther outreaching platforms that we're looking at. We are looking at a lot of B2C platforms and whatnot, just because of our lineage of Rakuten and our investments in Gojek and Carousel. But at the same time, we're looking at what does kind of the next specifically segmented D2C conglomerates look like. You see companies like Thrasio actually developing literally, companies and companies of D2C companies and developing that into one umbrella company. But I do believe that there's a next generation of things where you're looking at, a lot of these D2C companies becoming one entity and developing a bigger platform to actually reach their customers in a very sensible way. So looking at kind of, I guess for me, I really try to look at a wide spectrum as possible. And I say this as a joke, but I've invested in AI ML ops company, and I've invested in a D2C Wonder Bread company in Japan. Now, the latter actually makes a bunch of money. So it actually gives me pause as should I invest in another bread company or another AI company?
Well, I guess we all want to, get our daily bread.
Indeed.
So, and what do you avoid right now? What's passé or unattractive?
I would say on the fintech side, I am staying away from a lot of the lending businesses or the buy now, pay later kind of businesses that are out there for the perspective that the market is hypersaturated. The levers are just too simple to manipulate to actually manifest growth for investors or prospective entrants to look at and make it seem like there's a lot of opportunity there, where simply people are fighting for liquidity in many ways, just like how ride-hailing and ride-sharing companies initially were fighting with each other and competing while marketing themselves that they're growing and they have a sustainable business in their future back in maybe 2005 and 15 and 16.
Okay, we've got about 2 minutes left, so I want to throw just a little bit of a ringer, but let's imagine that you're interviewing a portfolio company that you're interested in taking an investment in, and you're meeting the founder. What's, based on your experience of doing this, what's like the best question that you've ever heard from a founder when you're talking to them? Simon, you want to give that a shot? I know I'm putting on the hot seat here.
So a question that the founder has asked me, right?
Yeah.
I think one of the best questions that I've received, and at the same time I've given back to them, is what keeps me up at night? What keeps you up at night, which is me, in terms of understanding and working with founders, because when you actually are able to answer that question very, very, honestly, I think the founders have a lot of wisdom to gain. At the same time, understand really the integral fit between that founder and investor. I think that's the best question I've received from a founder.
Mark, you want to best question?
I had a founder ask me what kind of multiple do I want back from this investment, and
infinity.
exactly. And so I just turned it back to him and says, what do you think you can do? But it showed a lack of interest in terms of, what was our ultimate gain. And, there is the element of, hey, we love to work with founders, and we do, because we, as I said earlier, we've been there. But at the end of the day, we have a fund to run, and we are return driven, and it has to be a perfect storm in order to make that investment. We have to find the right founder with the right opportunity, but also look at what's the return profile that we have in mind. So it was a smart question.
Yeah, to your point though, Mark, and your anecdote is that if the founder is just looking at a check, and they're not sort of thinking maybe a little bit bigger and a little more ambitious and a little more, I hate to use the word as cliche, but passionate about what they're doing, then they might find it hard to sustain it in the dark days, because there will always be some bumpy days. So with that, I'd like to, Anse Min and Mark Munoz, I'd like to thank you for your time. It's been a pleasure speaking with you, and good luck to everyone at the event. And please look us all up on LinkedIn or other social media. We'd love to hear from you. And from DigFin, I'm James DiBiasio.
Great. Thank you so much for the time today, guys. And again,
thank you.
Just hope you have a great event, and see you guys soon. Virtually and physically, of course.
Thanks, guys. See you.